record on this computer. Good. Recording is going. I just want to thank Sister Judy and thank everyone for coming on board tonight as we get ready to go into this very interesting study. And I know that it will be beneficial to us. And Sister Judy doesn't need a big, long introduction because she's part of the Grace family, and we're blessed to have her with us in the family. So, Sister Judy, just take over, and it's all yours. I hope she didn't leave us now.
Thank you, Pastor. Praise the Lord, everyone.
Praise the Lord.
Oh.
Yeah, you're going to have to get used to.
Do you hear me?
Yes, we can hear you. But there's no feedback, so you kind of have to get used to that.
I think it's a bit delayed.
Okay.
Okay. So praise the Lord, everyone. It's wonderful to be here tonight. You know, it's interesting because Pastor had talked about 2020 being a year of breakthrough, and then the pandemic happened, and everyone's just like, what is happening? And I thought I was going to get out of doing this presentation, but here we are tonight. Truly, we're living in a day when everything that can be shaken will be shaken. It's completely unprecedented. The financial system is volatile. The Bible says that in Romans 8:22, the whole creation groaneth. And if you don't know who you are, you will live far below what the Lord has in store for you. His word says, my people are destroyed for lack of knowledge. He intends for us to be the head and not the tail. He intends for us to prosper and not be in defeat. He intends for us to be above and not beneath. Why? So that there can be meat in his house, so that the kingdom can continue to accelerate and do extremely wonderful things in this final and last and closing day of time. What we need to do is not only pray for knowledge, you know, having the facts, but also wisdom and how to apply those facts. I look at the parable in Matthew chapter 25, starting in verse 15 to 18. It talks about the talents, and the principles in this parable are for everyone. God had the same expectation of the individual that he gave 5 talents to as he did the person he gave 1 talent to. And the 2 key observations I have with this parable is that God expects us to be prudent and to be wise with the resources he's blessed us with. And not only that, but those who are prudent and wise keep getting more. If you think about the one that took his 1 talent and put it in the ground, buried it, and did nothing, did not get a return, was instructed to give his 1 talent to the individual who took his 5 and made it into 10. Proverbs chapter 13, verse 22 says, a good man leaveth an inheritance to his children's children, and the wealth of the sinner is laid up for the just. I believe there's going to be a transfer of wealth in this last and final day into the kingdom for such a time as this, that God is going to do a quick work. I don't know how many of you remember a few years ago, Sister Flo was with us, and she preached the message about bamboo growth. And she talked about how just overnight, God can do something. You can look at this bamboo and the seedling in the, you know, it's been planted, and for years you don't see anything, and then just overnight it just springs up. And I feel and believe that in this time the Lord is expecting us to take our scarce resources, both our time and our money, be very, very prudent with it, and help to advance his kingdom. And he is going to bless those he can trust. And so we want to be in that position. So tonight we have a lot to get through, and I'm challenged to get through this all within an hour, but I'm going to do that. So we're going to cover a number of topics. Hopefully you had a chance to flip through the deck that was sent out earlier today. We're going to talk a little bit about what's happening in the markets, about setting financial goals, building a plan, the importance of credit, investing, saving for retirement, and then living a blessed life. Sorry, I should have mentioned at the beginning, I actually cannot see the chat. So if you don't mind, if you are putting questions in the chat, I'm going to ask somebody to please keep track of those. Maybe Sister City, if you don't mind doing that for me. And then at the end, we can stop and try and answer those or answer questions live at the very end. So the markets and what's happening. What I have done here is just cited a couple of very big stock market crashes. And it's indicated by the movement in the Dow. So the Dow dropping. You don't need to know a lot about the Dow. It's an index that houses about 30 US companies, the stocks, and it's used to indicate whether or not the markets are going up or the markets are going down. And so in October 1929, so almost 100 years ago, it was an unprecedented time then. It was a time called the Roaring Twenties. And at that time, it was actually quite similar to what it has been in the last 10 years in globally, particularly in North America, before the pandemic. So it was a period of rapid expansion. The Dow increased sixfold in the 10 years from 1921 to 1929. Many ordinary working class citizens became very interested in the stock market. They started buying stocks with easy credit, and the Dow dropped 25% over 2 days. It sent Wall Street into an absolute panic. Millions of investors were wiped out. People were doing basically a run on the bank, trying to get their deposits out. The bank closed, and then over the weekend, on the following Monday, opened up and paid out 10 cents on the dollar. People who had never even invested in the stock market were losing money, didn't have money to buy homes. It basically was the catalyst for the Great Depression, which lasted for 10 years from 1929 to 1939, which was the worst economic disaster in history. So that was 25% that the Dow fell at that time. More recently, in 2008, we had the financial crisis, which many would remember. This was triggered by the US housing bubble that saw house prices increase 125% between 1997 and 2006, which is basically for your house more than doubling in less than 10 years. People were borrowing against their homes to fuel consumer spending. There was excessive risk-taking by the banks who took on borrowers. They basically were lending out mortgages that to people who had poor credit or no credit history. They were allowing 0% down payment. They were interest-only loans, and then they were rock-bottom interest rates. And what happened was that when the interest rates reset, so within 6 months, so after they lured people in, within 6 months to a year, when interest rates reset, people couldn't afford the mortgages. And so the housing prices just tanked. Lenders weren't really concerned about the quality of the credit, because what they were doing is they were packaging up the mortgages and then selling them off their balance sheet. So there were a few really, really brilliant minds behind during that time who actually had lifted up the covers on what was going on and realized that these mortgages were about to all default, and that they were going to bet against the market. There's a book and a movie called The Great Short, where basically they had purchased instruments that allowed them to make money when the market crashed. There was the fall of many, many big companies. Bear Stearns was one of the companies that fell, but I think over 450 banks failed during that time. Canada was notably stable because our finance minister at that time was Paul Martin, and he put in place very, very strong regulations. So we were not doing the similar type of aggressive lending that they were in the US. And he was applauded actually for the fact that Canada made it through that crisis without stimulus packages and et cetera that you're seeing now that happened in the US. So what happened in March of this year was when the WHO declared the coronavirus a pandemic. That's when the markets, of course, started to tank. So on that day, it was March the 12th, the Dow had its largest drop in over 30 years just on that day. This decline of 23.2 is actually the first quarter of this year that I was measuring it to. But based on what I just described in history, I'm just trying to basically let you know that what's happening right now is pretty significant. The volatility that we're seeing in the markets is as a result of investor sentiment. Just before getting on this call, JP Morgan had just issued that they think that there's going to be a V-shaped recovery. So if some of the experts are saying that they think there's going to be a very quick bounce back from this, then markets go up, and then you hear about the pandemic having a second wave, markets go down, and it's just been like that since the pandemic was declared, basically. So the response from the governments have been to make sure that there's credit available and affordable to Canadians. Businesses need credit so that they can lend, and consumers need credit so that they can buy the essentials. The US stimulus package was $2 trillion, which is the largest in history. That roughly works out to be $6 per person. Canada's was over $100 billion, and that works out to be roughly $3 per person. So the size of these packages and all of the efforts that are happening have been absolutely huge. This, though, is going to be a recession like no other. The longer that we are required to stay home is going to determine the depth and the duration of this recession. You would have heard last week that Hertz just filed for bankruptcy. Hertz owns Dollar Car, they own Thrifty, they own Firefly. It's a huge company. Canadian banks today, the Bank of Montreal just released results, down over 50%. Royal Bank is down over 50% year over year. Scotiabank issued yesterday, they're down over 40%. This is huge. And just so you know, the quarters that the banks are on, the only half of the quarter when the pandemic was declared, so the results only reflect, are only reflected in half of the quarter. So when we see a full quarter's amount of the results next quarter, it's going to be very significant. So very, very bad times. I just, for interest, have shown some of the industries that will be down during this pandemic, post-pandemic, and those that will be doing well further down the line. So why is it important that we are taking a look right now at our finances and trying to have a breakthrough? Because we need to make certain that we do survive this time, but not only survive, as people of God, we need to thrive. And so we're not going to do the same things that we've always done. We're going to do things a little bit differently. And one of the important things are writing down, coming up with our goals, what's important to us, but then taking the next step of writing them down. So Pastor, in the last few months, had talked a lot about the power of thought. Sister Tracy came and talked about the power of your words and making declarations. The next step is to write your goals down. Statistics show that you're 42% more likely to achieve your goals if you write them down. So writing down forces you to get clear about what your goals are, and it also is motivational. I can't tell you how many times that I have written down goals, and then years later I've come across them and I'd be like, my God, not only have I achieved them, but I surpassed what I was praying for and what I was working towards. And it's very, very motivational. If you have goals that are for not just yourself, but for the family, for instance, if it's, we are going to purchase a house, one of the ways to write it down or to have it in front of everyone is to put a picture of a house on the fridge. So everyone knows what we're working towards and what we're sacrificing for, what the goal is. If just personal, if you can have, you know, recording your goals in journals or using a vision board, whatever it takes to get clear about what you're trying to achieve, and also to motivate you to keep the pace. Like, it's not always easy to stick to your plans, but it is easier once you have a constant reminder of your goals. Assign a timeline. A little word about this: you don't want to be too aggressive in your timeline. You want to have realistic goals. If you're too aggressive, it can lead to frustration and also unwise decisions. So, you know, there are no get-rich-quick schemes. That's not what I'm sharing tonight. So I want to ensure that, you know, when we talk about setting goals and timelines, that we are being realistic, but we're being aspirational. We are challenging ourselves to achieve and reach for something that is worth reaching for. And then building a plan. So that's what we are going to talk about tonight. So one of the first things you want to really take stock about is, what is your money personality? So everyone will be different. It's important to know what your personality is. And I have two individuals that are joining us tonight who have completely different personalities. Sally Spendthrift is very extravagant in her spending habits versus Frugal Freddie. So we are going to, you know, talk a little bit about them. Once you figure out what your personality is, it's then working with, okay, what boundaries or what aids do I need to put in place to ensure that I keep my goals front and center and I achieve my goals. All right. Some of the questions that you want to start reflecting on when you're setting your financial goals are here on the screen. We're not going to talk, or we're not going to ask people to respond on them, but there are things to think about. You know, who are the people that you would most like to interact with to make better financial decisions? Is it a spouse, a parent, other family member, a professional advisor? How many months of expenses do you have saved? And what are your top 2 or 3 goals? Is it education for yourself? Is it education for your children? A home purchase, retirement, vacation? What is it that you're working towards? So Sally and Freddie, they graduated at the same time. However, Sally notices that Freddie seems to be getting ahead. She asks for his help, and he's agreed to help her build a plan, a balanced budget, face her debt, and then to get out of debt. So we are about to embark on this. The very first thing we're going to do is look at setting a budget for Miss Sally. So a couple of key things you want to do, Sally, is to analyze your spending. So you need to take stock of where you're at. And it's easier to look back in time than to track going forward, just because sometimes it's kind of like when you're on a diet and you have to record something that you are going to eat, you tend to adjust the way you eat. And you might do that with your spending. So looking back at 3 months worth is a really good baseline to say, okay, this is how I'm spending. Capture every single transaction. Figure out what your income is on a net basis, calculate a monthly average, and then we're gonna look at the gaps. So here's the spend analysis worksheet that Freddie is helping Sally put together. She has taken a look at her expenses and her income for the first 3 months of this year, January, February, March. She's totaled them up, and then she's just calculated a simple average, monthly average, for to see where she's at. She then calculates what's the gap using the monthly average, the difference between her income and her expenses, and she's happy. She's like, Freddie, see, I'm doing okay. I'm in a surplus position. I've got $85 at the end of the month after everything I've spent. But what Freddie, being very wise, says to Sally is that, you know what, Sally, when I take a look at your revenues, there's a one-time item that is kind of skewing your revenues, and that's your tax refund. You got a big refund in March, and it's pumping up your revenues. And then when I look at your expenses, you've got a big expense in January. You went on vacation. You don't do that every month. That's a one-time. So let's remove those one-time items and see where your normalized monthly budget looks like. And when we do this, Sally is actually losing or running at a deficit of $500 plus a month. Not good. So some advice from Freddie for Sally is she needs to separate her needs from her wants. One way to do that is asking herself, will spending this get me closer to my financial goals or further from them? She needs to pay herself first. Put aside a bit of money each month into an account just for her. Live below her means. So this is probably the most challenging piece. Lifestyle creep is what happens when you start turning what used to be a luxury into a need. And if you think back, we've now been in this pandemic for 2 months. Take a look at what you've been able to live without for the last 2 months. Those would be in the luxury category, or more in the wants that you maybe don't need going forward. If you're saying, you know, I really want to get serious about changing my bad habits. Stop relying on credit cards. Challenge yourself to pay using cash for anything that doesn't increase in value. And then give yourself some time to get used to the budget. Don't just throw it away because it doesn't work in month one. Give yourself a couple of months to get used to it. So Sally, you're going to have to face your debts. And the way we're going to do this is we're going to take a look at everything that Sally has outstanding. We're going to order it in terms of not the amount that's outstanding, not largest to smallest, but on which one has the highest interest rate and is costing her the most, versus the one that is costing her the least. And then we're going to calculate what her true repayment timeline is. So listing her debts in order of how much it's costing her. She's got a Saks Fifth Avenue card. It's costing her almost 29% per month. She owes $1,200 on it. Her minimum monthly payment on that is only $36. Affordable, right? She also has the Bay, same type of interest rate, $21 a month that she's paying on that. TD Visa, a consolidation loan, and a student loan. So she's $53,000 in debt, and her monthly payments are $1,300 roughly a month. So the next step then is to take a look at what's her monthly payments, the minimum monthly, and what is the real interest rate that she's paying each month on these loans or credit cards. And so using the website debtcanada.ca, they have a credit card calculator, and Freddie was able to go on there, put each of her credit cards in there one by one, and it tells you what the monthly interest charge is. So the minimum per month, these minimum payments are designed to make your debt stick around forever so that your lenders profit. This is for the Royal Banks of the world. This is for BMOs of the world to continue to earn billions of dollars in profit. The $300 roughly that she's paying every month for the privilege of using someone else's money is expensive. So let's continue. What's next step? We're going to calculate her actual repayment amounts. What is she actually paying over time? So if she continues to just pay the minimum, the $1,357 per month, she will eventually pay off all of these debts but 6 years time, $1,200 on Saks Fifth Avenue. The total payment she's going to pay is $2,443 when she only borrowed $1,200, and so she's paying interest charges of $1,243. When I go through all of her debts, she's actually paying $15,000 in interest over the course of basically 6 years for the privilege of using somebody else's money. So Freddie takes a hard look at Sally and she says, you know what? My objective is to pay off all of my debt in 36 months or less. So she's going to have to pay more than the minimum. So how does she get there? She takes her outstanding balances and divides it by 36. So that is taking column B, the amount owing, just dividing it by 36. And the furthest column on the right is what her principal payments would be if she, and she stuck to those principal payments over 36 months. That's what she pays in principal. But to that, she needs to add the amount of interest that she's being charged every month. So when you add those together, her new monthly payment is now $1,780 versus her old monthly payment of $1,357. What she's going to do now is the difference between that new amount, which she's now going to put in her budget, and the minimum payment, she's actually going to, that's called the snowball payment. She's going to take that extra payment and apply it to her most expensive debt. So when she does that and makes that, you know, her payments across all of her debts are going to be the minimum, with the exception of the first one on the list, which is Saks Fifth Avenue. That extra $423, she's going to add to the minimum payment of 36. And instead of paying off Saks in 68 months, she's going to be able to pay them off in 3 months. So she does this across all of her debts. And you know, obviously, if she pays off Saks within 3 months, she's going to be extremely excited by the fact that she no longer has this overhead, and it just seems so achievable because it's quick. So what's the savings from accelerating the payments? She's going to pay off all of her debt in basically half the time. So instead of 6 years, it's 3 years. And the amount of savings in interest is roughly $10,600. She's not only saving time, but also in money. So it's worth it in the long term, okay? The long-term gain far outweighs the pain of having, the short-term pain of having to be a little bit stricter on her budget. So the advice from Freddie, final words to Sally, is be efficient. Pay off your most expensive debts first. Manage your credit cards. Be realistic about what you can afford. Track your spending and identify areas to cut back. And what you can't pay off, you shouldn't be purchasing in the first place. So when we look at the same principle on a mortgage level, the benefits here are profound. So by simply just changing the frequency of mortgage payments, so for instance, if you have a mortgage of $175,000 and it is at a 5% interest rate, and you take that $1,000 that is the monthly payment and instead say, you know what, I'm going to pay $500 every 2 weeks. Right away, the monthly payment would be paying $12,000 a year. By going to biweekly, you're going to actually pay an extra payment every month, every year. And that difference is 3.5 years that you're saving on this mortgage. 3.5 years, and the amount of money is over $20,000 in savings, which is huge, just by changing the frequency, which is amazing. So it's a principle that can be applied both to credit cards as well as to your mortgage. Let's talk a little bit about the importance of credit. Credit is an asset. Your credit rating is an asset. Everyone who's ever borrowed money or applied for a credit card or had a student loan, you've got a credit record. It's important that you check your credit record at least once per month. With identity theft, this is something that's really important during this time where people are really looking for financing right now. It's important that they have good credit if they need to tap into a line of credit, for instance, and don't have an emergency fund. So this is gives you an overview of what the scale looks like. It's not exact. There are 2 credit bureaus in Canada, so they will be slightly different, but in general, this is where the scores will land. And you're good if you're in and around the 700 score, and should be trying to maintain in and around that level. If your score is below 720, here are some of the things that you can do to improve it. Paying your bills on time is huge. So late payments will impact your score. And so it's important to do even the minimum on time, minimum payment on time. Reduce what you owe. So if you have a line of credit for $10,000, don't borrow $9,995. Like, try and borrow less than 50% of the outstanding balance. So reducing what you owe, not maxing out your cards compared to what's available is a good thing, and it drives 30% of the score. Other areas that drive the score is the length of credit history. So the longer your credit history, the better it is for you. For parents that have young adults that are just starting out or in their late teens, adding them on as a second to your account can help to build their credit rating quicker. Number of credit applications. So if you have too many hits on your credit report, too many lenders looking in a short space of time, that has a negative, it reflects poorly on your credit rating because it looks like you're shopping for credit and you're getting turned down, and so you look more risky. And then the mix of credit. Lenders like to see a good mix between revolving and installment. Revolving, you continue to be able to draw on that, but installment, you're paying it down. And so they like a mix, and not that you just have lines that never get paid off. So building an emergency fund. This is important for Sally to do. First, figure out essential expenses. And so going back to her spend analysis and saying, okay, which expenses here are, essential? I absolutely need them to continue to survive. Set up an account. You might have to start small, Sally, but start now. Find the money and treat your emergency fund as sacred. During the financial crisis in 2008, Americans learned the hard way just how important it is to actually have cash, because a lot of the banks at that time started to cut credit lines and close down accounts. They raised fees and raised interest rates, and all of that just to protect their balance sheets. JP Morgan Chase, one of the largest banks in the US, and Wells Fargo at the beginning of this pandemic actually began halting applications for homeowner equity lines of credit. So this is why an emergency fund is important, and you need to start now. Just like banks take time to build reserves, this is a time where you want to make sure that you're not drawing down on your reserves unnecessarily, and that you do have reserves in place so that you can survive shocks from illness, from job loss, whatever. You're not constantly turning to credit. You have something in the bank. So what are some of the common money wasters that we can talk to Sally about? Dining out at restaurants. No one's done that in the past 2 months. So you know that's part of the luxury camp. Using premium gas when your car doesn't really require it. Buying expensive clothes. We're not going anywhere right now. Dry cleaning clothes that you could wash yourself. Using brand name instead of generic brands. And then running up excessive cell phone bills. So these are things that Sally can be looking at. And there's other things, obviously, but these are some quick low-hanging fruit, I would say. So now we're into investing. And why invest and why is it important to invest? One of the basic reasons, everyone's heard about people, you know, years gone by talking about, you know, I'd rather just put my money in my mattress than I know I've got my money. Well, that doesn't work because if you do that, over time, your money is worth less just due to inflation. So if you don't earn on your savings at least what is greater than inflation, your money's going to be worth less. So what does that mean? A loaf of bread today costs more than it did 5 years ago. So your dollar is not stretching as far as it used to stretch. In general, as interest rates decrease, the economy grows and inflation increases. So it's important to take a look at investings and ways, safe ways that you can earn a return on your money. So 2 things to consider before you start investing. Number 1, do you have a lot of credit card debt? So it's pretty hard. You get an immediate return on your money if you're not paying 18% plus on credit cards that are outstanding on retail credit cards, for instance. It's pretty difficult to earn more than 18% consistently every year. I mean, you look at the rates that you get on your savings account, like it's, you know, even fund managers that are earning 20+% a year consistently. They're pretty rare. And so that's the very first place to start. If you have debt outstanding, that a lot of credit card debt, that's the first place to start earning money, by just paying that off and no longer having those expenses. And then, do you have an emergency fund? It's important to have funds in an account. We talked about that for when the unthinkable happens, just like now with the pandemic. So you might ask the question, how can I invest if I only have just a little bit of money? We've talked a little bit about this. There's a couple more things on this list, like, you know, Starbucks resonates with a lot of us. I mean, I know for myself, I used to love Starbucks. About a year or so ago, I couldn't pass Starbucks without going to Starbucks. And Starbucks coffee has got to be, well, for me, it was always north of $5. And having that every day. And then about a year or so ago, I decided I no longer needed Starbucks, and I haven't gone regularly for that amount of time. You can get used to anything you put your mind to. For me, it was it's just a change in lifestyle, and I just said, you know what, I just don't need this Starbucks. So looking at things like that are easy, low-hanging fruit, again, things that you think you absolutely need, but they're more wants than they are needs. Tax refunds. It's around about that time that people are getting their tax refunds. That's another area where you can find money to, you know, maybe you can't put it all in investing, but a portion of it. And then raises, and trying not to alter your lifestyle when you get raises, but instead at least putting a portion of that away. And it's so much easier when you do automated savings right off the top. And that's part of paying yourself first. Just saying, you know, I'm going to automatically, as soon as my pay is deposited, there is a portion that automatically comes out and goes into a savings account. For gifts from family members, etc., birthday gifts, asking for cash instead of some other perishable thing that you may not need another pair of socks, for instance. Types of investments. I just want to keep this very light and high level, but in the basic investments, you're looking at stocks and you're looking at bonds. Stocks are shares in the ownership of the business, and they can be very volatile. You're not guaranteed to have get all that you've invested out. They're riskier than bonds. Some companies do pay out dividends on a regular basis. Interestingly enough, with all the losses, or not losses, but the reduced income from the banks, they are, and our regulators are allowing our banks to keep dividends at their level that they have been for years, which is unheard of. In Europe, the regulators are mandating that banks cut back on their dividends at this time. So they're pretty defensive. There's a number of companies that are pretty defensive type investments. In other words, relatively stable, that can absorb some of the shocks that happen. But they are riskier, stocks are, than bonds. So bonds is companies or governments borrowing money from you, basically, and you're getting a guaranteed interest rate, and it's for a guaranteed or a set period of time. Mutual funds and exchange traded funds, these are vehicles that will own and hold both stocks and bonds and other types of investments. Mutual funds are actively managed, so they will be a little bit more expensive, and they will charge a management fee for these. Exchange traded funds are more passively managed, and so they tend to be cheaper than mutual funds. But again, it's just another way of purchasing either stocks or bonds or other types of investments. I wanted to touch a little bit on RESPs. So if you can, this is for parents, when your child is born, if you can start contributing to this right away, it is generally a good thing to do. All of us want our children to do very, very well, and would like to invest in their education. And education, as you know, is costing more now than ever before. And so any help, I mean, the government is helping you as parents to put money away for your children, and you should be doing the same. So to make it easier so that kids are not coming out of school with this mountain of debt on them. Generally, if you contribute $2,500 a year to this, that's the maximum. That's the maximum that the government will give a grant of $500. I'm seeing people ask questions, so I'm hesitating or wanting to ask questions, but I haven't seen a question yet, so I'll keep going. Up to a maximum of $7,200 in grants per year per child. I guess what I would say about this, anybody can contribute. Contributions to an RESP are not tax deductible, but the earnings on the money in the fund are not taxed until withdrawn. So you are contributing with after-tax dollars. So when you take out whatever you put in, you're not taxed on that, but any earnings on the funds you would be taxed on, your child is taxed on when they withdraw the funds, and also any grant money from the government, your child will be taxed on when they are withdrawn. Retirement.
Can we ask the question now?
Sure.
Okay, going back to stocks and bonds. So say for instance,
Yes.
you only have a small amount of money to put away. Would it be more beneficial for me to invest it in an RRSP rather than stocks and bonds?
Okay, so I'm glad you asked that question. So an RRSP is just a tax vehicle. It is not an investment. It is a way to lower your taxes. You absolutely, everyone should be maxing out their RRSP contribution every year. And what you put in your RRSP, you can open an RRSP and purchase both stocks and bonds. It's just a way to maximize your tax deduction and hopefully, your tax refund at the end of the year. It is not, that question I get a lot. It is, as I said, in an RRSP, you open up an account, you always should have a registered an RRSP. You can have several, but you do have limits on what you can contribute every year. So a small or large, yes.
Judy?
Yes.
Walter here.
Oh, hi, Walter.
How are you doing?
I'm good. I can't see anybody, so it's like I'm just staring at my screen. So.
Okay, I'll unmute and I'll put on my camera.
Oh, thank you.
Just wondering, what advice would you give to someone who is wary about putting in money in an RRSP as opposed to a tax-free savings account?
So both of them are tax vehicles. So they both help you to minimize the amount of taxes that you pay. The RRSP is the biggest bang for your buck because it is the only vehicle that actually reduces the amount of taxes that you pay. And so you should be trying to max out your RRSP before doing the TFSA. The TFSA contributions are basically for over and above if you've already maxed out your RRSP. Okay?
Okay.
The contributions to the RRSP, the tax-free savings account are with after-tax dollars, and so therefore they will, whatever you earn in that account is completely tax-free. But if you're being really savvy, you want to max out your RRSP first and then go to your tax-free savings account.
Okay. One more question. Would you also recommend, if you're somebody middle-aged and you're in a stable job and you are investing in our RRSP, would you recommend try to maximize the amount that you earn at that stage, and then as you get closer to retirement, you switch to less risky mutual funds or something like that to minimize your exposure?
Yes,
as you
absolutely.
retirement.
Absolutely. So I was just going to get into that. If people don't mind, I'll just keep going now. There are 4 key questions that you want to ask or are saving for retirement. And I'll just go through each one of these individually. So the first question is, how old are you and how much time do you have before you retire? So the earlier you retire is the more money you're going to need. If you start saving for your retirement in your 40s, which is very close to, you got a 25-year timeline, that's approximately, you're going to have to save a greater proportion of your income to make sure that you can get to the amount of savings that you need. If you start in your 20s, so if you're starting in your 40s, you're going to need to save 15 to 20% of your income to make sure that you have what you need when you retire. If you start in your 20s, it's 3 to 5%, okay? And then your age also determines the asset mix. So this is the question you had, Walter. Basically, if you are 5 years or less from retirement, your asset mix, what you are investing in stocks or equity, should be minimal, so 25 to 30%. If you're 10 years away, you can up that to, you can almost double it to like 50%. And if you're 15 to 20 years away, it could be even more, so roughly around 80% in that area. Because you're giving enough time. Go ahead.
Just one question. How do you determine how much you'll need to retire comfortably.
Okay, so the general rule of thumb is that you need 80% of your highest earning income. So whatever you're earning just before you retire. Presumably you're increasing every year, and so, or over time. And so you would want to, the general rule of thumb is that you can live on in retirement 80% of what you would have lived on prior to retiring. Okay?
Okay, thanks very much.
That answers the how much will you need and what sources of income do you have. Okay? So in retirement, you're going to have your company's pension plan, you're going to have the government pensions, which are measly, and of course your own investments that you're holding in your RRSP, right?
Okay, yeah. All right, thank you.
No problem. The third question is how much return will you earn on your investments? So the greater the return that you can earn on your investments, the less that you have to save. And that's why you want to be making prudent investments, right? That are earning a good return. The general rule of thumb is that if there's a rule of 72, if you divide into 72 the return that you are making, so for instance, if your return on your investment is 5%, divide it into 72, that's how long it takes to double your money, roughly. Okay, so if you're earning 5% every year, and you divide that 5 into 72, it's 14.4 years. It would take roughly that time to double your money. So of course, the higher the interest rate or the return, sorry, that you are earning on your investment, the less you need to save, okay? However, the higher the return, you know there's an inverse relationship. The higher your return is also the more risky or the less safe that an investment typically is. You're getting a return because you're accepting a certain level of risk, and you have to be comfortable with the amount of risk that is being presented. So there's a couple of things that you want to keep in mind. If you don't understand what you're buying, you shouldn't be buying it, okay? If you don't know the risks, you shouldn't be buying it. And if it sounds too good to be true, you shouldn't be buying it, okay? Any more questions at this point before I keep going forward?
Sister Judy, I have a question.
Sure.
When looking for a financial advisor, should we be selecting a different one for investments and then a different financial advisor for general savings, or should we just be looking for one person to handle both things?
Well, to me, that's personal preference. I mean, if you're not able to get all that you want from the one, there are so many investment advisors out there. You really should be interviewing and getting comfortable and making certain that you can ask your questions and get satisfactory answers. Mutual funds, for instance, you know, there's a prospectus. They are supposed to outline exactly what the asset mix is and why. There's so many questions that should happen in that first initial meeting that help you to assess whether this person is going to be good for you and vice versa, for them to say, you know what, can I properly support you? And so it really is personal preference. I don't have you should do that. There's no right or wrong answer is what I would say.
Sister Judy.
Yes.
Hi. I'm seeing commercials where people like for Quest Trade as opposed to having a personal investor. What are your suggestions on those? Because like their idea is that you're paying more to the person you're investing with as opposed to getting back. Do you understand my question?
I think I do. So it depends on.
They're saying that most of your fees go towards investment company as opposed to something like Quest Trade or something that you do on your own type of thing.
You have to know what you're doing.
Yeah, that's the problem with that. So you really have to be comfortable and understanding investments to be able to do this on your own successfully. It's not something that I recommend people just get up and start doing. One of the things that I've recommended people do is just quote unquote paper trade. And look at a stock, look at a mutual fund and watch it, week in, week out, and see, what, if I had purchased this, for instance, if in, January, the middle of January, you had said, what, I'm really interested in this particular mutual fund that is, in the energy sector, bad sector, energy sector. And let me see if I were to purchase this and follow it for some time, and then over time you realize, what, the oil is tanking and this is all tanking. So it gives you a flavor of, what are investments. And the principles I'm trying to share with you here are more around understanding your timelines. So for instance, if you have money that you want to invest and you want it to be in the stock market where you can make a lot of money in a relatively short amount of time, the problem with that is you can also lose a lot of money in a relatively short period of time.
Exactly.
It's riskier than being in bonds or just having a GIC, etc. So people, I talked about the Roaring 20s, where people were actually borrowing money to purchase equity. That's a double whammy of risk. It's something, it's not advisable. It's called leveraging, buying on leverager. And it's not something that is advisable. If you need your money in less than a year, you want to have less money in stocks because you need to be able to bounce back. You need that money, right? And you have no guarantee. So I started this presentation talking about how significant what we're going through right now is compared to the biggest stock market crashes in history. I can tell you that since this pandemic, Warren Buffett has had some really good advice. He is sitting on a stockpile of money, over $130 billion. His company, Berkshire Hathaway, right now has that kind of money they're sitting on. And he's being very frank. He's like, I don't know what's happening. And I'm not going to make a major move until things settle down and I understand. He's one of the wisest investors ever, most successful investors. And one of his things is, if people, he said, be scared when people are greedy and greedy when people are scared. That's his motto for investing. And if you can take a page from his book, it's typically you're not trying to just run and follow the horde. You're trying to be very knowledgeable and critical and asking these advisors every question in the book. And if they can't answer you in a satisfactory way, it's something to be concerned about. And you move on until you find somebody that is going to be helpful and work well with you. So at this point in time, I really wanted to finish this last slide. So living a blessed life and remembering that God loveth a cheerful giver. So I cannot overemphasize the importance of being a consistent tithe payer. It is a principle in the Word of God that is one of the only areas, or maybe the only area in the Scripture, where the Lord says, you bring the tithes and your offerings into my house so that there's meat in my house, and prove me and see if I will not pour you a blessing. I believe that post-pandemic, there's going to be a new economy. There's going to be new jobs. There's going to be new hot areas, and that God is going to bless those he can trust. I do believe that, when we do give, it should be an act of worship. It should be joyful. I can tell you that in my life, there are many times that I have proven God and he's blessed me tremendously. And I can point back to the Scripture. And if I ever find myself in a situation where I have to use the Scripture, he has never failed me. And over the years, it's something I have had an opportunity to talk to others about investing and about finances, but the base is always the same. If the Lord can trust you, he's going to bless those he can trust. It's just, it is a principle in the Word of God, and it works. There are people and business owners who they don't name themselves to be Christians, but they still use the principle and believe in the principle of tithing, right? So you see these huge philanthropic givers who believe in the principle of tithing and know that they keep getting more and more blessed. And so it's something I just want to remind us during this last and closing, time and this unprecedented time. Don't forget, when the Lord comes and he's blessing you and you're getting promotions and you don't know where it came from, and you're raised and in the middle of a pandemic, you're getting offers and you don't know why that's happening. It's tied back to your faithfulness. And God is more faithful than us, and he will not be outdone. He is going to bless, and he's going to stand behind his word. He loves us very much, and he's trying to prepare us for what he needs from, in his kingdom at such a time as this. So God bless you. Hopefully you got something out of that.
Wow. Thank you, Sister Judy. That was amazing. I think there is a question I saw let me just get my mouse to work here. Question I saw in the chat. What websites are available to track mutual funds and stocks? Lord, there's a ton of them. Maybe that's something that we could follow up with. The question there is, now there are websites. It's trying to find the best ones, because they're the ones that will lead you down a rabbit hole. So I wanted to add to the questions that came up from Simone and Sister Kalima and Sister Simone. Generally, Simone, what you will find is if you are talking to a financial advisor about one thing, for them to really give you a good picture of where you're at and where you're going, you're going to have to divulge all your information. You have to put all the cards on the table. So generally that person will have a very good, set of knowledge of everything you're dealing with. And they can probably, if you find a good one, you don't need to get multiple people. You gotta be careful that you don't get confusing signals. So Sister Judy is right. You find somebody you're comfortable with, and find somebody who's successful. I say that because I see people running around claiming to be financial advisors, but they're broke. You can't be advising me. It's like trying to have, it's like having, somebody being your coach or your gym coach, and they're out of shape. It doesn't work. You kind of look at that person and think to yourself, I want to be like that. So if you're going to listen to somebody, make sure also that they're not just have great talk, but try to find, just as much as they're finding out about you, you find out about them. Because if they don't have a track record that is attractive to you, if you don't want to be like them, then you don't want to be with them. And Sister Kalima, you're welcome. Sister Kalima was asking about E-Trade and stuff like that, and Sister Judy's right. They market themselves that way, that you save on MERs and you save on all this stuff, but you really have to know what you're doing. And if you don't know what you're doing, you're just gonna, it might as well you pay somebody to help you. Don't go into a fight if you haven't been trained. So if you don't know what you're doing, then stay away from those things, because you're gonna end up, probably losing your shirt in the process. So be careful with that. The key to that is knowing if you have good, strong investment knowledge, and Sister Judy said it well, you do a paper trade, you start practicing. Not with real money. You can take out your Monopoly game and use that money for now, and see how you're doing. If you're not doing well, then don't go in the real game. Let somebody that knows what they're doing guide you. All right. What others do we have here in this mutual funds? I think somebody had asked, had a question about RESPs, no investment funds. Okay. No, if are there any other questions on the call tonight?
Yes, Pastor.
Go ahead, Brother Walter.
In times like these, the stock market is taking a beating and so on. You have a little extra money to spend. What would you do? Try and buy a few stocks that are the value have been lowered, or try to invest in real estate, which also the value has been lower. How do you determine what to invest in and when to invest in it?
Go ahead, Sister Judy.
So it really depends on your timelines, and how quickly you want to see or have a need for your money. As I mentioned, you have to really be assessing. There's just no blanket answer for any of these. What I try to do is, earlier in the presentation, I think on slide 7,
yes, there was
or so, I had I'd included some of the companies that are really good defensive companies. They're Canadian companies. Loblaws is one, grocery stores and pharmaceuticals, they're going to do really well right now. That is something that you might want to watch. Their stock you might want to watch, and don't just watch going forward, but look back in time. Like, how have they done? If you invested in them 5 years ago, how are they doing now? You kind of have a good sense of real estate, but I can tell you, real estate honestly is going to be a little bit. It's got to have a longer timeline, but it's going to be safer than you could literally put your money in the stock market and it just blow yourself up in no time at all. So some of the stocks that I've listed there are stocks that, if you go back 5 years ago to up till now, even with the depression that we've had since the pandemic, they have had tremendous returns. And so, and a lot of these are, Loblaws, for instance, owns also, I believe, Shoppers. So they have both the grocery and the pharmaceuticals. Magna International, they're doing a lot of investing in these new self-driving cars. These are companies that are really set up for success going forward. We're always going to need banks, irrespective of what the Bitcoin, experts say. We're going to need that middle intermediary in the financial markets. Royal Bank is our largest bank, always paying dividends and huge reserves. They're down year over year, but they're going to bounce back. They've been down before. Look at what they were at 5 years ago versus what they are now. So if you're brand new to the stock market, mutual funds, ETFs, take a look at how they've done over the past 2-3 years. But recognize that your timelines and your risk appetite really drive where you're going to go. If you don't have a huge risk appetite, you might want to steer towards something that's a little bit more passive, a little bit more stable. You're looking at bonds, you're looking at real estate, etc. If you have a little bit more of a risk appetite and a longer timeline, you might want to, have a good mix that includes equities.
Just one more question, Sister Judy. When let's say you're going to invest in mutual funds and so on, do you only stick to Canada, or you try to get a mix of like the USA, emerging markets like India, Brazil, and all of those places and so on, to sort of have a mixed portfolio?
Yes, absolutely. So diversification is important. You definitely want to diversify your holdings. So I like to always, I'm so glad you asked this question because I didn't bring this out earlier and I should have. Your mix of assets should be just that. It shouldn't be all in any one area. It's good to, if you can, have a little bit in real estate, have a little bit in stock markets. The way you asked the question was, should I do one or the other? I tried to answer that, but ultimately you want to diversify the best you can. Mutual funds, there are so many on the market. just start asking questions, start just even Googling and just finding out the different areas that they invest in. And often mutual funds will have a good mix, asset mix, and they have to disclose what the asset mix is and who it's appropriate for. So these are some of the questions you're asking an advisor on, you know, given this is my timeline, I want to see my return in 5 years, you know, the asset mix should not be all 100% in stocks. I talked about where you should be. If you need your money in 5 years, you shouldn't have more than 50% of your portfolio of assets in stocks.
Right. Okay, thank you very much.
No problem.
And from the chat log, is mutual funds a good area to invest your money? You sort of partially answered that. Investing into GIC-RS. I'm not sure. It's not phrased in the form of a question. Oh. Into GIC, RSP, banking and utility provide. Oh, do they provide a good return? That's the GIC, RSP banking and utility.
Okay, so they're much more safe, right? If you do need your money in a shorter time frame, that's a really good, you know, a safer bet. The returns are going to be a little bit lower than if you're in pure stocks, because GICs are not the stock. So some of the things that drive the volatility in the markets, you know, every time, I have never seen the markets more volatile than having our dear president in the US in his seat. Every time he tweets, the markets go crazy. And so, you know.
And he tweets a lot.
Sorry?
He tweets a lot.
And so, you know, and he'll pick a company and he'll just say something and that company's stock will go crazy. It is really, the markets are reflecting people's emotions, their sentiments, their expectations, which change on a whim. If you don't have the stomach for that, GICs, that's passive investments, that's interest that you're earning. It's not going to be as big, but if your money, your hard-earned money is really important to you and you want to you know, protect that money, that's a good mix. You're going towards, you know, fixed income investments. Those are good. Bonds, GICs, and all of your mutual funds will have mixes of that. So you might want, you know, you may have a mutual fund that has both stocks and bonds, but if you are risk averse, you want your mix to be more heavily on the fixed investments. So your GICs, your bonds side, rather than more on the equity side. Does that make sense? More than 50% should be on the fixed income. So fixed income to me is your interest rate that your interest earnings that you are earning on GICs, on bonds, versus the equity, which you're going to generate either capital gains, so the stock's going up or down, capital losses, or you dividend income.
All right. That was the last question in the chat. If there are no more questions, I think we had a really great time tonight. If you have follow-up stuff that you'd like to ask, then you can forward them to me, and we'll see how much more we can lean on Sister Judy for some more insight into this. But Sister Judy, just on behalf of everybody, just want to say thanks for preparing all of this wonderful stuff. And thank you for solidifying it in the end with the importance of tithing. That's very essential. There's that verse that you quote from Malachi, which says, "Bring all the tithes into the stores, that there may be meat in my house." There's a dependency that God has upon us to do our part to make sure that there is meat in the house. So whenever we are taking care of doing what the Lord said, we're providing for him, and God blesses us in return. He says, "Prove me and I will show you."
Amen.
So let's do our part, brethren, and be faithful and watch the Lord get us out of this situation very successfully. Praise God. So thanks again. That's coming up also from in the chat. That thank you, Sister Judy, for everything tonight.
Thank you.
Good.
Thank